Here are 3 high dividend yield stocks that pay you monthly, and one of them is so new it may as well have been a secret. And I won't even use QYLD, XYLD, or RYLD in this list. As a dividend investor, I see drops in share price much differently than the average investor. Because share prices aren't usually tied directly to dividends, falling share prices usually means I can get the same dividends for cheaper. As the market inches closer to the bottom, these are the kinds of deals I keep an eye out for. The first ETF on this list pays 11.3% dividend yields based on December 15th closing price with an expense ratio of 0.35%. It's a covered call ETF, ticker symbol JEPI. It's offered by JP Morgan and it tracks the S&P 500, buys all the underlying stocks from each company on the index, and it buys exposure to covered calls on the S&P to generate additional premium income. These covered calls expire each month, which is how these ETFs are able to distribute monthly payments to investors. Next on the list is an ETF that pays 15.41% dividend yields based on its December 15th closing price, also at an expense ratio of 0.35%. This ETF is JEPQ, a covered call ETF that works just like JEPI, but tracks the NASDAQ index. And because of the higher volatility of the NASDAQ, covered call options on this index tend to make a little more in premium, which is why I tend to prefer this ETF over JEPI. At the moment, it just so happens this ETF has seen its share price go down as the rest of the market has. I'll throw up the recent price action on this ticker on the screen so you can see just how much it's dropped. Depending when you're watching this video, this ETF might have gotten even cheaper than it is right now. Last on our list is an ETF that's so new that Webull hasn't even listed the dividend yield yet. If we just use the worst monthly dividend thus far as the payment across all 12 months of the year, we can calculate a conservative dividend yield of 16.61% with a net expense ratio of only 0.35%. This ETF is ticker symbol TLTW. It's a US 20-year Treasury bond covered call ETF from iShares. It buys shares in another iShares ETF, ticker symbol TLT, which actually buys the Treasury bonds, and writes covered calls against the shares of that ETF. TLTW might be the least risky of these 3 ETFs since a 20-year Treasury bond doesn't fluctuate as much in value and is guaranteed by the US government. So even if the government doesn't have the money on hand to pay out on this bond, they can just print more money to pay you. Another thing I like about this particular ETF is that while they do write and sell covered calls that are OTM or out of the money, they also buy to close an option contract when practical to prevent assignment, which protects our potential for capital appreciation. Of course, as the Fed continues to raise rates, this ETF can perform better, so you'll probably see some good price appreciation during quantitative tightening. It's important to note that while the expense ratio is currently listed at 0.35% for this ETF, that's only because BlackRock is waiving a portion of its original expense ratio until February 2028 when it goes up to 0.5%. Because premium income on these covered call ETFs can fluctuate depending on the performance of the underlying securities, your dividend income can also fluctuate over time. However, if you buy into these ETFs on a dip, you stand an even better chance of getting a great yield long term. If you like this video, you might also enjoy this one here on the screen. Subscribe and hit the bell for notifications so you don't miss a single video. As always, you should do your own research before investing into anything. This video is not financial advice.